If you have even a passing interest in current events, you'll know that there has been the occasional snippet in the news in the last week or so about the pound, Kwasi Kwarteng's mini-budget, the Bank of England, the cost of living, loads more besides. And many investors are freaking out, and to a point that's understandable. But let me try and help you with something approaching a rational response to all this. Hi and welcome back to the channel. My name is Pete Matthew. I'm a chartered financial planner based in the UK. And as you can imagine, I've been having some, shall we say, interesting conversations with clients and with viewers in the recent days. And for the most part, that isn't because their portfolios are looking really unhealthy. They're down a bit this year, but certainly not catastrophically so. No, they're getting in touch because the relentless tide of news, bad news, is weighing on their minds, and so they turn to me and my advisors for reassurance. So what is it that I'm saying to them? Firstly, it's worth mentioning that I am not an investment expert. Now that might surprise you, but not if you've been here for a little while. Investing can be extremely complex, or it can be very simple. And there's a lot of talk at the moment of things like bond yields, lowest ever exchange rates, the impact of those things, and lots more. Clearly, it's important to know something about what's going on and why it matters. So in the description, I'm going to link to two videos that do a much better job than I ever could at explaining this stuff. There's one video each from Pensioncraft and Damien Talks Money, who I think are the best finance creators on YouTube, bar none. But if I had to try and distill what's going on right now into a kind of pithy sentence, it would be this. And crucially, it's always this. Factors influence sentiment, which moves markets. So let's break that down. Factors first. Stuff going on. Things over which you and I have absolutely zero control. And right now, the list is long and pretty unpleasant. The war in Ukraine, energy price rises, government intervention to try and stem those price rises, a new government acting like traditional conservatives, something which hasn't happened in ages, the Bank of England acting to offset the impact of the so-called mini-budget, and all of this just as the world is recovering from the once-in-a-century event of the global pandemic. That, by any measure, is a lot of stuff happening at once, and it's all leading really to the one thing which is the overarching story, and that's inflation. Stuff getting much more expensive. Add to that the relentless news feeds, just rehashing the same stories 24 hours a day, all with downward-pointing, jaggedy red arrows and inflammatory headlines. It all just feels a bit crap. And of course, on top of it all,
winter is coming.
Winter really is coming. Don't know if you could see, but it's raining here. But the two videos that I've linked to are actually quite pragmatic about the fact that not everything is rubbish. Certainly things are not necessarily as bad as we might be led to believe. But all of these factors, and many more different ones in the future, will continue to happen. Might as well get used to it. We can't do anything about it. And this sentiment, this feeling that things are a bit crap right now, gives us an insight into why markets, and hence your pension and your ISA values, are so volatile. All markets and the assets that they represent are driven by supply and demand, fundamentally. And the second half of that, demand, is itself hugely driven by sentiment. So take the pound right now. The fact that we have the Treasury and the Bank of England seemingly pulling in different directions doesn't exactly inspire confidence that the powers that be know what they're doing. And to investors, that is a big turn-off. So the government wants to borrow more to spend their way out of the current difficulties and, apparently, to trigger growth. And so they issue gilts. That increases the supply. Increase the supply of anything, and generally the price is lowered. But the demand, driven by this sentiment that maybe the powers that be don't know what they're talking about, it just isn't there, and that will lower prices too. Put those two things together, and prices have been so depressed that the Bank of England has had to step in and start buying up all these gilts to reassure markets. And that is an exact U-turn on what they're supposed to be doing right now. I mean, add all that together and it's not a great look, is it? Now, importantly, while you and I can temper our own response to the current climate and everything that's happening, we are insignificant individual specks compared to the market as a whole. But what is the market really? Well, it's just the collective measure of the impact of supply, demand, and sentiment on any given asset, whether that's equities, bonds, gold, or whatever. Generally speaking, the market as a whole prices in all the various factors well in advance of you or I being able to do that. It is the sum of all available understanding about what's happened in the past, what's happening now, and what might happen in the future. And the level of the market takes all of that into account. But now and again, markets get spooked by something completely unexpected. The ridiculously named mini budget a week ago had exactly that effect. China devaluing its currency in 2015 did the same thing. Remember that? COVID in 2020, that spooked the markets. These unexpected events usually have a very big and sharp impact. But usually, things revert to some kind of normal before too long. Whether that'll happen this time, I just don't know. And I don't know how long it'll take if it does. Anybody who says they do know is a liar. Before we get on to what our reaction should be, if this is useful, please hit the like button, subscribe to the channel if you're not already, it really does help, so thank you in advance for doing that. So how should we as investors react to all this? Well, on this channel I preach lazy investing in the form of global passive multi-asset funds, tracking markets instead of trying to beat them. And of course if you're tracking markets, following them, and markets go down, you're going to follow them down. That's just the way it works. The belief is that generally, over time, with reinvested dividends and income, markets rise. But right now, it's volatile and our fight or flight mechanism wants to be doing something, anything, to try and limit the damage to our portfolios. But answer me this, what exactly are you going to do to make any material difference to your portfolio right now? You could switch everything into cash, get out of the markets and wait it out. But with inflation running as high as it is, that's just guaranteeing a loss in the buying power of that cash. And then, of course, you have to make another impossible decision, which is when to get back in. It's just a fool's errand. Don't even try to time the markets like this. You could change the mix of your investments, perhaps. But if everything is volatile right now, how exactly are you going to decide what to move in and out of? What percentages are you going to come up with? And can you even stick to whatever decision you make, or will you want to change it again in the next month? Constant tweaking of a portfolio is spectacularly damaging in the long term, in most cases. So if selling into cash is a bad idea, tweaking the allocation is just as much of an unknown, we really are running out of options. And so, perhaps unsurprisingly, we return to the mantra of passive investors everywhere. Just sit it out. Log out of your investment accounts, stop watching the news and go and do something more interesting instead. You will not lose all your money if you're invested globally. Because for that to happen, every company and every country in the world would have to fail. And if that happens, we have got much bigger problems than the value of our pension fund. But if you need to spend your invested money in the short term, I hate to say it, but really it shouldn't have been invested anyway. You might have to just accept your losses, maybe defer the spending you had in mind until things recover. Really not a great outcome, I'm afraid, but there's really no magic wand to fix it. If you're approaching retirement, try and remember that it really doesn't have to be a kind of cliff edge event. Probably your money is going to stay invested in your pensions and your ISAs and stuff for a long time yet. So again, try to think in terms of decades, not just the current crisis, if indeed this is a crisis. But if you're worried, and if you have an advisor, then talk to them. If not, leave any questions under the video. Tell me I'm wrong and I'm an idiot if you want, I don't care. Better still though, join the Meaningful Money Facebook group. I'll put the link here and in the description. There's strength in numbers and that Facebook group is an incredibly positive and supportive bunch. But thanks for watching. I'm going to return to the risk discussion that we started last week in the next video, so I'll see you then.